Good morning and welcome to the inaugural Aristotle Capital Management webcast. My name is Steve Borowski. I'm the president of Aristotle Capital Management, and with me this morning is my partner of 25 years, our CEO and Chief Investment Officer, Howard Gleicher. 2012 was a very good year for Aristotle for a number of reasons. Number one, we grew in assets under management significantly. Number two, and almost most importantly, we had a number of wonderful people join the firm, some old friends, some new. And then number three, we had a very good year, we believe, from a performance standpoint. Ultimately, it's where the rubber meets the road. We thought this would be a very good time to instigate a series of webcasts where you can meet and communicate with a number of our investment professionals to learn a little bit more about who we are, what we do, how we think, and ultimately how securities get in the portfolio. What our format is going to be this morning is Howard's going to spend the majority of his time on the process, the methodology, and why we do what we do. And then I'll come back a little bit later with a brief review of performance, and then we'll turn it over to questions and answers. But before we launched into that, I wanted to give you a little bit of background on Aristotle Capital Management as an organization. We are an employee-owned organization. We have offices in both Los Angeles and Irvine, California. We manage right now about $3.3 billion for institutions and individuals throughout the United States, throughout Canada, and throughout Europe. We have 33 people in the organization, 9 of which are members of the investment team, and we manage 4 separate and distinct strategies. We have value equity, international, global, and global opportunity. And on that note, I will hand it over to Howard.
Thanks, Steve. I want to also give you my warm welcome and thanks for joining us today. I really appreciate you taking the time, and I hope to make it worth your while. One of the reasons why we want to speak with you today is to make ourselves as the investment team and myself available to you so you can better understand what we do and how we do it. Our investment team is focused primarily on uncovering great businesses and understanding business models around the world. We also have a client service and marketing team and an operations team that handles most of the rest of the business. We would like to hold these webcasts periodically, at least several times a year, similar to the way many corporations hold earnings calls throughout their fiscal years. Today I want to spend a few minutes talking about how we are different and how our investment philosophy and methodology are utilized here at Aristotle. For those of you who have known Steve and I for the past few years or for the past 25 years, you will find great similarities to what we've said during that period of time. Today, there are over 6,400 stocks listed on major U.S. exchanges, but over 11,000 registered investment advisors just in the United States. So why Aristotle? The answer is very simple and very straightforward. We look to understand great businesses. We're not trying to find the next stock. We're not trading stocks. We're not buying a piece of paper at one price and looking to sell it at another price. We're just looking to understand businesses. I, as part of the investment team, and our entire analyst and portfolio management team scour the world and try to find why one business is better than another. Why does one company have a higher market share in canned peas than its closest competitor? This is what the fundamental underlying philosophy of Aristotle is, and this is what we believe makes us very different from others. So please refer to the philosophy and process slide on the screen. Note on the left-hand side, we talk about the 4 pillars of the Aristotle investment philosophy. On the right-hand side, the 3 elements of the investment process. Let me go through each of those with you now. The Aristotle investment philosophy, as I said, has four components to it. First, we start with high-quality businesses. Next, we take a global perspective. Third, we use a long-term view, and we put together focused portfolios. Let me take each of those one at a time, because we really believe that the way we implement this is different from others. The first element of looking for high-quality businesses. We are not, as I mentioned briefly before, looking for the next best stock. We're just looking to understand great companies. What are examples of high quality? Examples could be high or improving market shares, high or improving returns on invested capital, consolidating industries, growing market share within a business, predictability, stability, companies that perform well in times of adversity. These are examples of high quality. Next, we take a global perspective. Why is that important? We've been talking about being a global manager for a very long period of time, before it was common to do so. It's important because the world increasingly is globalizing from an economic standpoint, even from a political standpoint, where ramifications of incidents in one country have ramifications throughout the world. Even industries in the US, which used to be an island unto themselves, now have global competition. Take telecommunications, for example. It used to be that one would analyze AT&T or Verizon or its predecessor Baby Bell companies, and that's all you needed to do. Today, one needs to analyze Deutsche Telekom in order to get a true understanding of the competitive dynamics within telecommunications in the United States. Why is that? Because Deutsche Telekom owns T-Mobile USA, the fourth largest wireless cell phone provider. Take Sprint, number 3. They are entering a partnership with Japan's SoftBank. So one cannot simply look at US companies in order to gain any kind of advantage over the outlook of that particular industry. One must look globally. This is increasingly the case, not only here in the United States, but around the world as well. The third component is we take a long-term view. We don't get caught in the news of the day. Yes, we do try to understand what's happening on a day-to-day basis and a month-to-month and a quarterly basis with each company. But that's more for us gaining a better understanding of the big picture of where a company is headed over the next 3 to 5 years. What are the true prospects of this enterprise? How is it going to change? And how will those changes affect the individual business in which we're looking at? We also look for inflection points in businesses or industries. What's going to change tomorrow from where it was yesterday or today? A good example is energy. No one can doubt that through technological change, we around the world are able to extract oil and natural gas where we couldn't before. Therefore, vast reserves, particularly in the continental United States, are now opened up for exploration and production of natural gas assets. What are the ramifications of this? Could we one day have a fleet of natural gas-powered trains? Could we one day have a fleet even of natural gas-powered trucks and aircraft? That's all possible. And so we're trying to understand the ramifications tomorrow for changes in that industry today. The fourth element of our investment philosophy is the creation of the focused portfolios. If we're going to do all this work and we're going to travel around the world understanding these great businesses, and we're going to take the time on each one visiting factories and better understanding management, then we want the ability for this to properly impact the portfolios in which we invest, and we don't want to be pressured that we have to buy or sell something today or tomorrow. We want to be able to take the proper amount of time we need to make the right decision based on all of these factors that we've been talking about. That results in approximately 40 investments in our value equity portfolios, roughly 35 to 40 in our international portfolios, and roughly 45 to 50 different investments in our more broadly based global and global opportunities portfolios. Each of our client portfolios, value equity, international, global, and global opportunities, use this same investment methodology. We apply them to different universes, but the underlying philosophy and the way we implement it is the same. Referring back to the chart now on philosophy and process, let's look at the 3 elements of the Aristotle investment process: high quality, valuation, and catalysts. We call this the Aristotle smile test. Why do we call it that? We call it that because it neither begins nor ends with value. Notice value is in the middle. We start by understanding these high-quality companies and trying to find the best ones around the world. Steve, I know you like to call that playing in the right sandbox. That means that if we're in a business by being invested in the particular company and we make a mistake, and we have in the past made mistakes, we currently have investments that are going to be mistakes, and we will make mistakes in the future, do we want to make sure that those mistakes aren't disastrous to the portfolio? If we have a great business and a great company, we're assured that the mistakes will be limited. Let me give you a few examples of what a high-quality business is. Predictability is one example. Possibly predictability in a commodity business, typically those that are not very predictable. Clorox needs resin or plastic for its Clorox bleach bottles. It used to hire Dow Chemical to provide the vast majority of those plastics. One day, another competitor walked in their front door and said, "I can sell you those same plastics at 2 cents a pound cheaper. Are you interested?" Clorox said, "Sure, we'll save two cents for the identical product. Sign us up." Within a month, the new company was having problems in supplying and in having problems in keeping the quality of the plastics up to the standards of Clorox. The 2 cents they saved was not worth it. They immediately called Dow Chemical back, and once again, they had almost exclusive market share in the Clorox bottles. That's an example of predictability that's not often evident just by looking at the characteristics of an otherwise cyclical business. Another definition of high quality is how does a company perform in times of adversity? We're very proud of the fact that at the very beginning of the financial crisis in late 2007, we owned several of the banks in this country that today are market leaders. JP Morgan Chase is one example. During the entire downturn, while their stock price was affected by everything that was going on in the marketplace, they continued to increase their market share of the businesses in which they compete. They were able to buy Bear Stearns at almost a zero value and increase their share in investment banking. They were able to buy Washington Mutual at a very low price and gained a foothold in the California huge marketplace for retail banking and deposits. This is an example of a company that thrived when others around them were floundering. And that's an example of a quality business and a quality company. We continue to look for those kinds of businesses around the world, anywhere we can find them. Other examples of fundamental strengths that we've found are growing market shares, such as eBay in the online retail and electronics payments spaces, improving margins for other chemical companies in addition to Dow, or improving returns on invested capital for many consumer staples companies that are able to charge higher prices for their goods or services because of the recognizable brand names. The next attribute of the SMILE test is valuation. It's necessary, but it's not sufficient in and of itself. Valuation rarely wins out as a reason for us to invest in a company. And as I'll discuss later, valuation in and of itself is not a catalyst for us to invest in a company. But it is required, and it's important. Typically, the way we look at valuation is what we sometimes refer to as private equity in the public markets. We use this analysis, largely cash flow based, because it's more of an absolute measure of value, not relative to other companies. We're not looking to invest in a company with a PE ratio of 12 because its peers are at 15, or invest in a company just because we think its earnings are going to grow and it will grow into its existing valuation. We look to invest in a business where its cash flows can justify the entirety that we would pay for that particular business. If you've known us before, I've often asked Steve to write me a check for X billions of dollars so I can buy the entirety of a business, including all the equity outstanding and its debt and any unfunded obligations that we may find. That way, Steve and I would both control 100% of the cash flows of that business. If we're able to control the cash flows of that business, and we know exactly what we have to pay for those cash flows, and we can calculate what those cash flows are going to be in the future, we'll do a calculation which is called cash flow return on economic value. Cash flow return on economic value, typically a number like 10% or 12%, is the number that we use to compare to what a knowledgeable investor would pay for the entirety of this business in the marketplace today. We would then compare that number to a risk-free rate or to a required rate of return that investor might require in order to have his or her investors happy with the investment. This cash flow return on economic value is what we use as the bedrock or minimal price that we attribute as to the intrinsic value of the enterprise of the business that we're looking at. The third element of the Aristotle smile test is the catalyst. On the slide in front of you, you'll see two columns. The right-hand column shows what catalysts are, in our opinion at Aristotle. The left-hand column shows what catalysts are not. Now, one of the big differences between Aristotle's definition of catalyst and perhaps what others may think is that we're looking for fundamental business catalysts as opposed to stock price catalysts. A stock price catalyst might be an activist investor taking a particular holding of a company and trying to force management to unlock value of the enterprise. We see that as possibly good for the stock, but not necessarily good for the fundamentals of the business. So what we do see as catalysts for the fundamentals of the business would include things that you see on the right-hand column, such as new leadership. Could be that the past manager was underperforming and a new CEO has taken over and is now capable of handling the company's business much better than his or her predecessor. It could be marketed new products. Could be increasing market share of products that are on the marketplace today, not necessarily just in development. Sustained and or increasing cash flow and how that cash flow can be used for the benefit of the business. Accretive acquisitions that have already occurred. Changes in output volumes. Ongoing restructuring of the business that is either in place or is ongoing over periods of time. Or industry consolidation. One of the industries that we have seen a tremendous consolidation on recently is the airline industry. Now, while I wouldn't necessarily run out and invest in airline stocks today for various other reasons, it is something that makes us take note and we ask ourselves the question, in an industry which has historically not earned its cost of capital, can this new consolidated industry be a better steward of shareholders' capital? And what are the ramifications for that? And what are the ramifications for those who supply aircraft to airline industries? And what are the ramifications for passengers themselves? These are the kind of things that we look at in terms of identifying and understand catalysts and their ramifications for the businesses. Now, what catalysts are not are things such as a cyclical rebound or an industry cyclical rebound. Terminated management. Yes, a particular company may have a poor management team and that management team is terminated, but do we know that the new one is going to be any better than the one that was just replaced? Expectations of new products is not a catalyst. It's the new product in the marketplace that would be the catalyst. Hope of unlocking value, ability to restructure, all of these things that could be, that we hope, that we wish, that we would like, not catalysts. And anything else that we believe is not in the control of the company or management team, things such as listed in the chart in front of you. So with this presentation today, I hope we've given you at least the beginnings of an understanding of the Aristotle methodology and the Aristotle process. You can find more information on this and other topics and individual viewpoints that we may occasionally have in each of the essence that we write once a quarter, our quarterly report to our investors and other interested readers, which can always be found on our website. Steve?
Thank you very much, Howard. Well done. I'm going to just spend a few moments on performance until we move on, to questions and answers. Despite a number of potential headwinds that the U.S. equity markets and global equity markets faced in 2012, the S&P 500 still managed to produce about a 16% return for the year and was up another 6% for the first couple of months of 2013. Our value equity strategy had a very, very good year. We've produced a net return of 21.4% for 2012. That's 540 basis points ahead of the S&P 500, 390 basis points ahead of the Russell 1000 Value Index. Howard and his team for quite some time now, coming up on 20 years, have done a tremendous job managing this particular strategy, and we certainly hope that we can continue that going forward. International. Sean Thorpe and Jeff Stewart co-manage our international strategy here. The track record officially became 5 years old as of the end of December. They've done a tremendous job during 2012. They were up a little over 18% net, 18.1 to be exact, which was a little ahead of the index, but what is special here, what I think is unique here, is that for the 5-year track record, they have averaged over 600 basis points annually since its inception. We think it's going to be a huge part of our future, and we're very, very excited to work with Sean and Jeff on this particular strategy. And then our global strategy, this is something that Howard has overseen. He's been the lead strategist for quite some period of time. Last year, we produced a net 16.3% return, which although was about 20 basis points less than the index, again, over an extended period of time has added a great deal of value. Having said that, what we'd like to do now is to move into questions and answers. And I know that many of you have and will be sending in some questions. And if we do not have the ability to address those questions right now, we can certainly get back to you within the next few days. Howard, here's our first question. How are investment decisions made from sourcing the idea to making the investment?
Thanks, Steve. I really love talking about how it is that we do our job because we just have such a passion for it and love looking at companies and understanding businesses. We primarily focus on the investments that we have today. I and the rest of the investment team are not out there looking for new ideas. We're looking to understand each day, incrementally, just another little piece of what maybe we didn't know yesterday about the companies in which we have an investment. While we do that, we look at the company's peers, we look at the company's suppliers, we look at the company's customers, we look at the company's distributors, and we look at the entire value chain around the company and the products in which it participates. Sometimes, in this process, we'll uncover new opportunities that, for whatever reason, we believe are superior to the opportunity we had at the time. So, using just a couple of examples, both in the food-related industry, and I want to be fair, so let's take one example of a company where I feel fundamentally maybe things didn't work out too well. Another example where fundamentally things did work out well, in our opinion. So we were looking at a number of food-related companies, and we wanted to understand the ramifications for changes in the distribution of the food products in the United States. So we started looking at supermarket companies. We started looking at supermarket companies, and we were introduced to Steve Bird, the CEO of Safeway, one of the largest supermarket companies in the United States. We found Safeway to be a good quality business, very predictable cash flows, very stable, high returns on invested capital. We found its stock price to be meaningfully under our estimate of the intrinsic value of its enterprise. And we found many catalysts available at the time that we were looking at Safeway. For instance, they were dramatically upgrading their store base in the US, spending $1 billion or more to make sure that their stores were bright and light and served good products, and expanded their product range into a category higher end than they used to. We thought that made a lot of sense, particularly in the markets in which they competed. However, their timing was awful. They started doing this right at the beginning of the recession that we just came through, and the money that they spent was essentially wasted. because people weren't interested in shopping in higher end, nicer, brighter stores. They just wanted cheap prices. At the same time, we saw an increasing fragmentation of food purchases in this country to where dollar stores, drug stores, even gas stations, certainly Costco and Walmart and Target, started increasing their share very meaningfully of the food retailing business in the United States, and Safeway lost share. So it's an example where the catalyst that we had identified actually came through, but the fundamentals of the business deteriorated through our time of looking at this company. Another example, a little more positive, is a company called Conagra. Conagra is a food manufacturer. Famous brands of theirs you may be familiar with are Banquet Frozen Foods, Healthy Choice Frozen Foods, Hunt's tomato ketchup and tomato sauce, and other consumer packaged and canned food goods. CEO Gary Rodkin, shortly after he took over as CEO of this company, decided to divest the company of a very large and capital-intensive commodities trading business. We saw that as a huge catalyst to improve the business because Mr. Rodkin and his team could now focus on the food parts of the business. He did that, came out with new products such as Healthy Choice Steamers, which was very well received in the marketplace, and fairly dramatically increased his share even within a challenging category of frozen foods. So the catalyst worked out, the business did well. Eventually, however, we did not understand Mr. Rodkin's new foray into private label goods via his acquisition of Rallcorp, and we decided that Conagra may no longer be an appropriate investment for Aristotle clients. So, that takes you from idea generation through to the sale of two different companies.
Terrific. Thank you very much. And this next question is actually two-part. How does private equity activity in the public markets impact your valuation process? And number two, how do you think about your investments from a takeout valuation perspective? If we can remember all that.
I'll certainly try. Well, the idea of private equity playing an increasing role in U.S. public equities is important only so much as it might impact stock prices. And it really highlights the difference that we're trying to portray to you here today as to how we at Aristotle are looking at the fundamentals of the business. Private equity investors typically have a relatively short payback period that they're required to offer to their own capital investors. Those are typically 5 to 7 years. While our investment time horizon of 3 to 5 years is similar, we don't take an activist approach to investments that we make. We're looking for improvements in the fundamentals of the business as opposed to a restructuring of the stock price in that business. To answer the second part of the question about how we think about takeout valuations, it is a part of what we think about, but it is never a driving force or a catalyst. There are times when a company, in our view, is clearly worth a lot more than the valuation being accorded in the marketplace today. So some of the parts or private market valuation would have an impact to our thinking that if the company can get its act together and can truly realize the value of the businesses that management is currently stewarding, there could be significant upside to the valuation accorded that particular enterprise. But it's not a catalyst for us. It's simply part of the SMILE test, which says if it's a good business and we think the stock is cheap, are there catalysts available other than a breakup or a takeover that would result in the narrowing of that valuation gap?
Terrific. Thank you. And one other question here. How do you expect your business to change over the next 5 years? Let me tackle this one myself. Whether it be 5 years, 10 years, 15, 20 years, it doesn't matter. Everything that we do and everything we have always done is focused on our clients. What is ultimately in our clients' best interest? the last 10, 15 or so years, there's been a proliferation in hedge funds, alternative investments, and countless times I've had people ask, phone calls, where people would ask me, not if, but when are you starting a hedge fund? And the answer is always the same: we're not. We don't plan on it. I believe that if we can continue to add significant value, not every quarter, not every year, but significant value over the indices, over our peers, on a risk-adjusted basis, in a liquid manner, on a cost-effective basis, from a very transparent standpoint, there's plenty out there for us. We will do quite well. So we're not going to change along those lines, but again, it's very much client-focused. And I don't know, Howard, if you want to add anything to that.
No, Steve, as always, you give the best answer.
Okay. I think we have time for one more question here, and it's a lengthy one, so bear with me. In the past, when we have spoken, you have said that you are focused on buying great businesses with little regard to the overall market environment, but that in times of extreme market conditions, the market environment could be more relevant to your thought process. Would you consider the market conditions over the past several years and at present to be extreme, and are you giving more consideration to the environment in light of that?
Steve,
I told you it was long.
I knew we couldn't get through a Q&A without someone asking about the current market. So I actually prepared a slide for that I took from one of our prior essences that we wrote a couple of years ago. In direct answer to your question, as always, no one will be surprised by this, I am not going to comment on recent market performance or what I think is going to happen in the short term. However, the chart here shows our thoughts on a much longer term view. This shows the long-term drivers of equity performance over the prior 20 years, ending in 2010, so from 1990 to 2010, and our expectations for the next 20 years, from 2010 through 2030. And the major thing I want to point out is in each of the 5 categories, which we consider to be market drivers, we see the next 20 years being somewhat less than the prior 20 years. Let's take these in turn. So the first thing that drives equity prices typically is the average risk-free rate, typically T-bill rates if we're talking about the United States. Currently, they're 0. They've averaged between 3 and 4% over the last 20 years. Now, I don't know where they're going to go over the next 20 years, but starting from 0, they'd have to go up to more than 10% in fairly short order for them to average the same amount that they did over the past 20 years. We don't think that's likely. So we've indicated an average risk-free rate over the coming 20 years of 0 to 3%. Inflation, big topic, lots of controversy. I would agree with a lot of others who have said one might expect significant increases in inflation coming over the coming years. But we just don't see it. It's not here today. And part of what we do is we look at the world the way it is, not the way we think or even want it to be. So I would have to say if inflation was, let's say, 2 to 3% on average, core CPI, over the last 20 years, then maybe it'll be a little less than that, 1 to 2.5% from 2010 through 2030. Periods of much higher inflation in there? Possibly. Periods of much lower inflation in there? Possibly as well. But on average, over that longer period of time, we're thinking 1 to 2.5%. Population growth over the last 20 years in the United States has been fairly robust, 1% a year. That's due both to demographics and due to immigration into this country. While a lot of those factors are still with us, to some extent they're with us a little less. And so while in population growth was about 1% in the past 20 years, I would say a little less than that going forward. Productivity growth, still very, very strong. The advent of the internet, the advent of a number of productivity tools that businesses have had to drive their own productivity rates over the past 20 years has been enormous. Do we think it's going to continue? Yes. Do we think it can continue at the same rate as we've seen? Possibly not. And so we're saying productivity growth about 2% a year rather than the greater 2% that we had seen. And finally, leverage. Companies, individuals, governments, the United States, the worldwide, were increasing leverage over the past 20 years. And regardless of what one believes about the market or economy or their political persuasion, we think that leverage will not go up the 1% that it did over the past 20 years, and actually could go down somewhat, as we've seen the last several years. Adding all that together, you see on the left-hand side of the chart, the markets grew 9 to 11% annualized over that period of time. Over the coming 20 years, not this quarter, not this year, Steve, not even a couple of years, we're thinking it will average 3 to 7.5% over that time period. I hope that answers the question.
I think so. See, we're bumping up against our time limit here. I would like to close by thanking all of our clients, the consultants we work with, all of our constituents here at Aristotle Capital Management for our success and making that success possible. Before closing, I did want to mention that 2 of our strategies, our value equity strategy and our global opportunity strategy, are both available in mutual fund format. We sub-advise the Harbor Funds Large Cap Value Fund. That information can be found on harborfunds.com. And our own global opportunity strategy, you can find that on aristotlefunds.com. I'd like to mention also that our next webcast will feature Sean Thorpe and Jeff Stewart, who are the co-portfolio managers on our international strategy. And with having said that, thank you very much and have a great day.